Disney is in a danger zone ahead of its earnings next week, but the market doesn't suspect a thing. Actually, it's just the reverse. They're expecting everything, and that's why there's a danger. I'm going to explain that whole thing in just a second. Let's talk about Disney for a moment. So, I follow an approach. I call it expectational analysis. You can guess. It has to do with the market's expectations, the behaviors, etc. Sentiment is at the core of it. Let's talk about the three pillars of a trade when you're trading this way. First of all, there are technicals, there are fundamentals, and then there is investor sentiment. I'm going to do the fundamentals first because they're kind of easy. I call it a walk down Main Street. Just walk down Main Street and look at what's working and what isn't working, and that can usually give you a good view of the fundamentals of a company. Sure, you can go out and start to look at ratios, scores, all kinds of things. There are dozens and dozens and dozens of pieces of quote-unquote data, but they all take a different view, and nothing really can get to the heart of things like looking at how a company's operating. So how's Disney been operating here recently? Well, we know the last 2 quarters have seen a lot of pressure on the streaming services. Disney Plus has lost subscribers 2 consecutive quarters in a row. Last quarter was 4.5 million subscribers, and they blamed that on dropping cricket in India, I believe it was. But let's look at the real picture here. It really is about the streaming landscape. Netflix is becoming a ruler in this area again. The stream has gotten too wide and too shallow. And what I mean by that is you've got everybody that's in the streaming pool right now. Warner Brothers, you've got Paramount, you've got Netflix, you've got Hulu. You've got a ton of competition in this area, and you and I are getting a little tired of it, and people are not cutting the cord. That's what we did years ago. Instead, we're cutting off those streaming services, and Disney is one of those that's right at the top of the list of getting cut. Why? Well, it's what they offer. They've got their catalog, which obviously we all know about, but you and I are typically into watching something besides a very narrow funnel of what's being offered. That's the whole idea behind streaming, right? Now, they've got ESPN, and right now that is that kind of leveraging pin right now that I think could make a difference for Disney, because obviously we all want to watch sports, but we know that DirecTV lost the NFL ticket to basically YouTube, which is Google, and that would have been a really nice thing for Disney to be able to add to that Disney Plus. I'm not going to go into all of that. Let's just narrow this down and say the streaming service has not treated Disney as well as it did a couple of years ago when it was released, and that's putting pressure on the top and bottom line. The other side of this is the park, obviously, and the movies. Movies, we've seen some production, but remember, that strike is going on with not only the writers, but the actors. That's pressure on the fundamentals. Also, the park business that we see. Domestic travel is starting to slow down as people are going international. You're going to have people that are going to Disney, either of the parks or any of the parks that they own, because it's a thing, right? It's like going to a Grateful Dead show or something like that. You have the followers. But with more people opting to go international, domestic travel is going to slow, and I suspect that's going to put a little bit of pressure on the parks and also discretionary spending. We're still seeing, even though inflation is ebbing, a lot of people that are still tightening the purse string. So from a fundamental perspective, and that's all I'm looking at there, my walk down Main Street, I have to be a little suspect of what Disney's going to tell us next week. Let's move on to the technicals here. And for that, I'm going to go to the chart, of course. This is your chart, your daily for Disney. I'll get the pen going here for a moment, and you'll notice that the 2 metrics I've talked about, and if you follow me, you're going to know this. The 50-day moving average, that is the green line. That is the one thing that you can look at that says the trend is your friend or the trend isn't your friend. That 50-day moving average is in a downtrend, and it has been for a few months now, telling us that Disney is not in a friendly trend. The other measure I use on this is the 200-day moving average. That's a longer-term trend, which is also negative on Disney shares. Then I'm going to back out and really look at the long term, and this is where things get a little bit troubling. Disney is trading below its 20-month moving average. Now, there's something special about the 20-month. That's it right there, the orange line. A stock that's below its 20-month moving average is considered in a technical bear market. Forget about the 20% from its highs and 20% from its lows for a bull market. This is the measure that will be consistent in technical analysis, whether you're below your 20-month moving average. And This is one of those companies. In the S&P 500, they're 35%, 32% really, but below its 20-month moving average in a bear market. That's important to keep in mind when the rest of the market's in a bull market. The other thing is when you start to look at this chart of Disney and really look back historically, and I'm talking about going back a few years now, what you're going to find is that this is a company that is getting ready to break through some very long-term levels of what you would say normally is support. By that, I mean I'm looking at the pandemic lows. We'll come up with that in just a second, right here in April of 2020, and then going all the way back to 2016 and even 2014, you'll see that there's one price point that has tried to hold the stock up right in here. Boom, boom, and then back here. That's the $85 price. If we slip below the $85 price, which is exactly where Disney's been bouncing around here for the last month or so, you're going to start to break into territories that we haven't seen in more than a decade. That's going to rattle some cages out there. The analysts, investors like you and I, sure, you can look at it and say it pays a dividend, but when you're one of the bottom performing Dow stocks, and it's in the bottom half, it's not the worst. That's Walgreen Boots Alliance, but if you're looking at the performance against the Dow, Disney is definitely a laggard. So here we go. Technically, the stock is in a bear market. The short and intermediate term technicals, the trend is your friend, are not friendly right now for Disney. So we've got two marks against it. The fundamentals are poor. The technicals are poor. Now let's move on to the third, and that is a key. That is sentiment, folks. Sentiment, especially in this market, has been driving almost everything. What I'm talking about are expectations, and I told you I would get to this. So expectations have been everything for the last month or so. And what I mean by that is what investors actually expect. You hear things like whisper numbers and what are the analysts talking about? I'm talking about what investors can read from the sentiment. And right now the sentiment is very optimistic for Disney. That should be a good thing, right? No, that's what puts it in the danger zone. So right now, you've got about 70% of the analysts that cover the stock. They rank it a buy or a strong buy. That's a strong majority for a stock that's in a bear market. And sure, I can be very, kind of sentimental and say, hey, everybody loves Disney. But the point of the matter here is that everybody should not love Disney right now, yet they do. When you look at the options activity, calls have been very active on Disney stock, telling us that options traders are out there trying to get into Disney because they think that the stock is going to go higher. Another sign of optimism. And when I look at another thing that I can't believe this lined up, but check it out with me. Last weekend in Barron's, we got this. A magazine cover, a cover from Barron's that tells us Disney's magic will return. It's time to buy the stock. Now, Barron's has a long history of being a good indicator from a contrarian perspective. So in other words, if they say it's time to buy the market, if they say it's time to buy a sector, or if they say it's time to buy a stock, it's typically not a good time. This is another sign and kind of the crown jewel of that sentiment that we see towards Disney right now. Optimism. I'll even say this is hopeful optimism because they're looking for a bottom when right now the fundamentals and technicals don't match. So what's this all mean? How do you trade this? How do you do something with this? First of all, if I were an owner of Disney shares, which I am not, I would be selling them right now ahead of earnings. Sure, even if we did get some good news from ESPN, or possibly, a new CEO coming in as they are starting to look for a replacement for Bob Iger, it might give the stock a little bit of a bump here in the short term. But the overwhelming evidence is that the fundamentals and the technicals are going to continue to wear, and that bump would be short-lived. And 85 is going to be in the rearview mirror on our way down to a 75 or even a 70 on the stock. That's my price target right now as we go towards the last quarter of the year. So we've got a couple of months here, maybe even 3 or 4 for that to play out. If I'm not a holder of the stock and I'd like to get aggressive about it, what do? Well, I go out and I buy a put. I speculate that the price is going to go down. If you don't know how to trade a put, you can check out a number of our videos and we'll walk you through that. You're basically taking a position that will go up in value as the stock goes down, which is, again, what I expect. Where do I think the next level of support for Disney is going to be? Right around this $80 level is going to give us some support. After that, I think we drop down to a $75 price tag, even so far as $70 per share on Disney. Would I be a buyer at that point? Time will tell. Right now, fundamentals move very slow. I'd have to see a turnaround in the technicals. And the most important part is I'd have to stop seeing people hope that the price of Disney was going to go higher. Now, I've told people, some of my followers, how I'm positioning for this. I'm actually buying a very long-term put. I go out to November on this, and I buy it at the $90 strike. It costs me about $7 or so. Check out the information on moneymorning.com, and you can get details on that trade. Otherwise, stick with me. I'll follow up after the Disney earnings hits the tape next Wednesday and give you a little more guidance on exactly how I'm trading. So that's it. You've got a situation where there is a stock sliding down what I call the slope of hope. Lots of people looking for hope in Disney as we run into earnings, and that is a danger sign. Expectations are high when the stock is pointing that it just wants to go lower. Hope you will follow and share, obviously, these videos. We'll give you more tidbits like this on how you can gain an edge in navigating the market. I'm Chris Johnson from moneymorning.com. Have a great day.